Most investors spend their entire lives chasing a market that does not always reward the chase, and that is exactly where the problem begins. Vitaliy Katsenelson, a seasoned portfolio manager and deep thinker about markets, wrote this work not just for professionals, but for anyone who truly wants to understand what is happening in the world of investing and why the old rules do not always apply. This is not about get-rich-quick ideas. This is not about tips or hot stocks. This is about understanding the nature of markets at a deep level, recognizing where you are in the cycle, and making smart, disciplined, rational decisions that protect and grow your wealth over time. If you have ever felt confused about why the stock market goes up and down without warning, why some investors seem to do well even when markets are flat, and why blindly buying and holding an index fund may not always be the right answer, then this is exactly where you need to be right now. Let us begin from the very foundation and build upward together, step by step, idea by idea, so that by the end of this journey, you will have a new lens through which to see every investment decision you make. Markets are not always going up, and this is the first truth that every serious investor must accept. We have all grown up hearing that over the long run, stocks always go up. And while that statement has some truth to it, it hides a very important and often painful reality. There are long periods in history when stock markets go essentially nowhere. Not down in a dramatic crash, but not up in a rewarding way either. They move sideways, swinging back and forth, sometimes for a decade or more, leaving investors frustrated and confused. Katsenelson calls these periods range-bound markets. A range-bound market is not a bear market exactly, and it is not a bull market either. It is something in between, a market that oscillates within a range, going up for a while, and then coming back down, never really breaking out decisively to new highs for an extended period of time. The United States stock market, for example, went through a range-bound period from roughly 1966 to 1982. That is 16 years of essentially going nowhere. Another range-bound period began around the year 2000 and lasted for over a decade. These are not small blips. These are massive chunks of a person's investing lifetime during which the buy and hold crowd earned very little or nothing at all in real terms. The critical question then becomes this: what do you do if you believe you are in a range-bound market? Do you just sit and wait for a bull market to return someday? Do you pull your money out and put it under the mattress? Or do you find a smarter, more active way to invest that actually works in such an environment? Katsenelson argues passionately and convincingly that the answer is active value investing. And to understand active value investing, you first need to understand what drives market prices in the first place. The price of a stock, at its most basic level, is driven by two things. The first is earnings, meaning how much money the company actually makes. The second is the price-to-earnings ratio, commonly called the P/E ratio, which is essentially how much investors are willing to pay for every unit of earnings a company produces. Think of it this way. If a company earns $10 per share and investors are willing to pay 15 times that earnings, the stock price will be $150. If those same investors become more optimistic and are willing to pay 20 times earnings, the stock price becomes $200, even though the company itself has not changed at all. This expansion and contraction of the P/E ratio is one of the most powerful and least understood forces in investing. During great bull markets, both earnings and P/E ratios rise together. Companies earn more money, and investors also become more willing to pay a higher price for each unit of those earnings. The result is spectacular gains for investors. But during range-bound markets, even if earnings grow, the P/E ratio falls or stays flat, canceling out the gains from earnings growth. This is why investors in range-bound markets can feel cheated. The companies they own may be doing well, growing their profits year after year, but the stock prices do not reflect that growth Because investors as a group are becoming less optimistic, less willing to pay high multiples for future earnings. The reason P to E ratios fall during range-bound markets is rooted in human psychology and economic conditions. After a long bull market where everyone made money and became euphoric, investor expectations are sky high. People expect stocks to deliver enormous returns every year. When reality cannot keep up with those inflated expectations, disappointment sets in, and investors are willing to pay less and less for stocks. The transition from a high P to E environment to a low P to E environment can erase years and years of earnings growth. This is deeply important to understand before we go any further. Now, knowing that we might be in a range-bound market, the question becomes, how do you actually make money in such a market? And this is where Katsenelson's framework begins to shine with real clarity and purpose. The answer, he says, lies in being genuinely active and genuinely selective. Not active in the sense of trading every day like a machine, jumping in and out of positions for tiny gains, but active in the sense of being deeply engaged with what you own, why you own it, and when to sell it. In a range-bound market, you cannot rely on the rising tide of a bull market to lift all boats. You need to find the specific boats that are going to rise on their own merit. That means finding truly great companies at truly reasonable prices, holding them while they deliver value, and selling them when they have reached their potential, then recycling that capital into the next opportunity. This is the essence of active value investing. It sounds simple, but the execution requires a framework, a discipline, and an emotional toughness that most investors never develop. Let us now get into the specific framework that Katsenelson has built and refined over years of real investing experience. He calls it the QVG framework. Q stands for quality, V stands for valuation, G stands for growth. These three elements together form the complete picture of what makes a stock worth buying, worth holding, and ultimately worth selling. Let us explore each one in serious depth, because together they form the backbone of the entire active value investing approach. Quality is the first and arguably the most important of the three. When Katsenelson talks about quality in a company, he is talking about several specific and measurable things. He is looking at the strength of the business model, the sustainability of competitive advantages, the quality of management, the financial health of the balance sheet, and the predictability of earnings. A high-quality company is one that has a durable advantage over its competitors, a reason why customers keep coming back, and why other companies cannot easily take market share away. In business literature, this is often called a moat, like the moat around a castle that protects it from attackers. A great business has a wide moat. It might be a strong brand that customers trust deeply and will not switch away from. It might be a proprietary technology that competitors cannot replicate. It might be a network effect where the product becomes more valuable as more people use it, making it very hard for any newcomer to compete. It might be extremely high switching costs, where once a customer is locked in to using a product or service, changing to a competitor would be so painful and expensive that they just stay put. These moats protect the company's ability to earn high returns on its capital over time. And high returns on capital are one of the most reliable signals that you have found a truly great business. But quality is not just about the business model itself. The quality of management matters enormously. Katsenelson spends considerable time on this because he has seen over and over again that even a great business can be ruined by poor management, and even a mediocre business can be significantly improved by truly excellent leadership. When evaluating management quality, the active value investor looks at several things. First, does management have a strong track record of allocating capital wisely? When the company generates cash, does management deploy it in ways that create long-term value, such as making smart acquisitions, investing in high-return projects, or buying back stock when it is undervalued? Or do they waste it on ego-driven acquisitions that destroy value, or on projects with poor expected returns just to keep busy? Second, is management honest and transparent with shareholders? Do they communicate openly about both the good news and the bad news? Do they take responsibility when things go wrong, or do they blame external factors and make excuses? Third, are the interests of management aligned with the interests of shareholders? Do they own significant amounts of company stock themselves, meaning they feel the same pain and joy that shareholders do? Or are they paid primarily in salaries and bonuses that reward short-term performance at the expense of long-term value creation? These are not easy questions to answer, and there are no perfect companies. But by studying annual reports, listening to earnings calls, reading interviews with executives, and following the company over time, a diligent investor can develop a reasonable sense of management quality. The balance sheet is another key component of quality. A company that carries enormous debt is inherently more fragile than one with a clean, conservative balance sheet. When hard times come, and they always do eventually, a heavily indebted company may struggle to survive, while a debt-free company with cash reserves can actually take advantage of the downturn to acquire competitors or invest in growth at attractive prices. Katsenelson has a strong preference for companies with manageable debt levels and strong cash generation. Companies that generate more cash than they need to run and grow their business have enormous flexibility. They can weather economic storms, invest in new opportunities, return money to shareholders through dividends or buybacks, and generally operate from a position of strength rather than fear. The predictability of earnings is the final major component of quality. Some businesses are inherently more predictable than others. A utility company that provides electricity to homes and businesses will earn relatively steady profits year after year because people always need electricity. A company that sells a fashionable consumer product might have great years and terrible years, depending on whether consumers like this season's offerings. Katsenelson is not saying you should only invest in boring utilities. He is saying that you should understand the level of earnings predictability in any business you invest in, because it affects how confident you can be in your valuation analysis. The more predictable the earnings, the more confidence you can have in your estimate of what the business is truly worth. Higher quality companies deserve higher P/E ratios, all else being equal. If you find a high-quality company trading at a low P/E, that is potentially a very attractive opportunity. But quality alone is never enough to make an investment decision. You also need to consider valuation. Valuation is the V in the QVG framework, and it is where many investors make their most costly mistakes. There is a common misconception, particularly among new investors, that buying great companies is always a good idea regardless of price. This is simply not true. Even the most wonderful business in the world can be a terrible investment if you pay too much for it. Katsenelson is crystal clear on this point. Price matters enormously. The price you pay determines the return you will receive. If you overpay, your returns will be disappointing, even if the underlying business does extremely well. If you pay a reasonable price, you give yourself a margin of safety that protects you if things do not go exactly as planned. The concept of margin of safety comes originally from Benjamin Graham, the father of value investing, and it remains one of the most powerful ideas in all of investing. The margin of safety is the gap between the price you pay and the intrinsic value of the business. If a business is worth $100 per share and you buy it at $80, you have a $20 margin of safety. That cushion protects you against mistakes in your analysis, unexpected negative developments in the business, or simply being wrong about the future in ways you could not anticipate. The active value investor is always hunting for stocks that offer a meaningful margin of safety. Not just stocks that seem cheap, but stocks that are cheap relative to a carefully calculated estimate of their true intrinsic value. Calculating intrinsic value is more art than science. because it requires making assumptions about the future, which is inherently uncertain. But there are rigorous ways to approach it that significantly reduce the range of error. One approach that Katsenelson discusses is discounted cash flow analysis. The idea is straightforward in principle, even if the math can get complex in practice. A business is essentially a machine that produces cash over time. If you can estimate how much cash that machine will produce in the future, and then discount those future cash flows back to the present using an appropriate rate, you arrive at an estimate of what the business is worth today. The discount rate represents the return that investors require to compensate them for the risk of owning the business and for the time value of money. Money today is worth more than the same amount of money in the future, so future cash flows need to be discounted to express them in today's terms. The challenge, of course, is that future cash flows are uncertain. Small changes in your assumptions about future growth rates or discount rates can lead to very large differences in your intrinsic value estimate. This is why Katsenelson emphasizes the importance of conservative assumptions and meaningful margins of safety. Rather than trying to precisely calculate the exact intrinsic value, the active value investor looks for situations where the stock appears to be obviously and significantly undervalued based on a range of reasonable assumptions. If a stock looks cheap under optimistic assumptions, pessimistic assumptions, and moderate assumptions, that is a much more compelling situation than one that only looks cheap if everything goes perfectly. Another important valuation tool is relative P to E analysis. Every stock has its own historical range of P to E ratios that reflects how the market has valued it in the past under various conditions. By comparing a stock's current P to E to its historical range, and also comparing it to the P to E of similar companies in its industry, you can get a sense of whether the market is being overly pessimistic or overly optimistic about the company's future. Katsenelson also talks about the importance of understanding what is already priced into a stock. When a company is going through a difficult period, its stock price often falls dramatically. But sometimes the market overreacts, pricing in a level of pessimism that is more extreme than the situation actually warrants. This creates opportunity. Conversely, when a company is doing extremely well and everyone is excited about its prospects, the stock price often reflects an extremely optimistic future that leaves little room for error. Even if the company continues to do well, the stock may deliver poor returns because that great future was already fully priced in. The active value investor tries to buy when the market is being excessively pessimistic and sell when the market is being excessively optimistic. This requires patience, discipline, and the ability to go against the crowd, which is psychologically one of the hardest things to do in investing. Growth is the G in the QVG framework, and it adds the final essential dimension to the investment picture. Growth matters because it drives the future earnings that determine future intrinsic value. A company that is shrinking in revenues and profits is becoming less valuable over time. A company that is growing strongly is becoming more valuable. But not all growth is created equal. Katsenelson makes important distinctions between different types of growth that are crucial for investors to understand. The first distinction is between earnings growth driven by genuine business improvement versus earnings growth manufactured through financial engineering. A company can boost its reported earnings per share by buying back its own stock, even if its underlying business is not growing at all. When there are fewer shares outstanding, the same total earnings divided among fewer shares produces a higher earnings per share number. This is not necessarily bad, and Katsenelson is not saying buybacks are always wrong. But investors need to be clear about where the earnings growth is actually coming from. Growth in total earnings, driven by genuine expansion of the business, more customers, higher prices, new products, new markets, is fundamentally more valuable and more sustainable than growth in earnings per share driven purely by buybacks. The second distinction is between organic growth and acquisition-driven growth. When a company grows by acquiring other companies, the growth can look impressive on paper, but it often comes with significant risks. Acquisitions are difficult to execute well. Integration challenges are enormous. The acquiring company often overpays in competitive bidding situations, and the target company's management and employees, who were crucial to its success, sometimes leave after the acquisition. Organic growth, meaning growth that comes from the company winning more customers, expanding into new markets, and developing new products on its own, is generally more reliable and more valuable than acquisition-driven growth. The third important dimension of growth is sustainability. How long can this company sustain its current growth rate? A company growing very fast in a new market may be exciting, but if that growth rate is likely to slow dramatically in a few years, as the market matures or as competitors catch up, the value of that growth is limited. The active value investor tries to identify companies with sustainable growth, driven by durable competitive advantages, in markets that have long runways ahead of them. These companies can compound value for shareholders over many years, and when you find them at reasonable prices, the long-term rewards can be spectacular. Now that we have explored all three elements of the QVG framework, let us understand how they work together. The goal is to find companies that score well on all three dimensions simultaneously. High quality, at a reasonable valuation, with sustainable growth. This combination is not easy to find, but when you find it, it is genuinely powerful. Sometimes you will find a great quality company at an attractive valuation, but with limited growth prospects. This can still be a good investment, particularly if the valuation is very compelling and the dividend yield or buyback program is meaningful. Sometimes you will find a company with exciting growth prospects at a reasonable valuation, but with mediocre quality. This is riskier because the lack of a durable competitive advantage means that competitors can, and likely will, erode the growth over time. The framework helps you think clearly about these trade-offs and make more informed decisions. Let us now move into what may be the most psychologically challenging part of active value investing, the question of when to sell. Most investment books and most investment education focuses almost exclusively on what to buy. There is very little guidance given on when to sell, and yet selling decisions are just as important as buying decisions, if not more so. Katsenelson devotes significant attention to this question, and his thinking on it is both original and very practical. He argues that there are three main reasons to sell a stock. The first is that the story has changed. When you bought the stock, you had a thesis, a set of reasons why you believed this company was a great investment. If one of the fundamental elements of that thesis has changed in a way that undermines the original investment case, that is a reason to sell. For example, if you bought a company because it had a dominant competitive position in its market, and then a new competitor emerges with a genuinely disruptive technology that begins to erode that competitive position, your original thesis is now compromised. The company you own is not the same company you bought. The active value investor is always watching the businesses they own, monitoring them for changes that could fundamentally alter the investment case. The second reason to sell is that the stock has reached or exceeded its estimated fair value. Remember, the active value investor buys with a margin of safety, meaning at a price significantly below estimated fair value. As the stock price rises toward fair value and beyond, that margin of safety disappears. The investment is no longer cheap, and in many cases, the stock may actually become overvalued, meaning that the market is now pricing in an overly optimistic future. At this point, the risk-reward equation has shifted unfavorably. The upside from further price appreciation is limited, while the downside from a reversal to fair value is significant. This is the time to sell. Many investors find this very difficult emotionally. When a stock you own has been rising and everyone is excited about it, it feels wrong to sell. You worry about missing further gains. You see other people still buying in. You read positive articles about the company. All of this creates powerful psychological pressure to hold on even when the rational analysis says it is time to sell. The active value investor must develop the discipline to sell when the analysis calls for it, regardless of the emotional discomfort. The third reason to sell is that you have found a significantly better opportunity elsewhere. Opportunity cost is one of the most important concepts in investing. Every dollar you keep in one investment is a dollar you cannot put into a better investment. If you are holding a stock that is fairly valued and growing at a moderate pace, and you find another stock that is significantly undervalued with excellent prospects, it may make sense to sell the first and buy the second, even if there is nothing wrong with the first. This is why active value investing requires ongoing research and a pipeline of ideas. You need to always be looking for new opportunities so that when you find something genuinely compelling, you have the analytical foundation to act on it. Now let us go deeper into the psychology of investing, because this is where most investors fail, not because they do not have access to good information or good frameworks, but because they cannot manage their own emotions and biases. Katsenelson is deeply aware of the psychological dimension of investing. He understands that the stock market is not just a financial machine, but also a machine that manufactures emotions, fear, greed, hope, regret, pride, and many others. These emotions are enormously powerful, and they consistently lead investors to make decisions that hurt their long-term returns. Let us start with fear. When markets fall sharply, fear grips investors. The news is full of doom and gloom. Friends and colleagues are talking about how terrible things are. Every day brings new headlines about economic catastrophe. In this environment, the natural human instinct is to sell everything and hide. But this instinct is almost always exactly wrong from an investment perspective. Market declines create bargains. When great companies are selling at dramatically lower prices through no fault of their own, simply because the market is in panic mode, that is when the active value investor should be buying aggressively, not selling. Warren Buffett has a famous phrase about this, though we will not quote it directly here. The idea is that the wise investor is greedy when others are fearful, and fearful when others are greedy. This sounds simple, but executing it in real time, when every instinct in your body is screaming that the world is ending, requires extraordinary psychological strength. Katsenelson helps investors develop this strength by giving them a rational framework to fall back on when emotions run high. If you have done your homework and you know that a company is worth $100 per share and the stock has fallen to $60 purely because of market panic, you do not need to feel afraid. You need to feel excited because you have been given the opportunity to buy more of a great company at an even better price. The framework gives you an anchor of rationality in a sea of emotional turmoil. Now let us talk about greed, the other great destroyer of investor wealth. During bull markets and periods of great enthusiasm, stories circulate about people who have made spectacular returns in short periods of time. Friends tell you about the stock that tripled in 6 months. Social media is full of people bragging about their gains. The pressure to participate, to take bigger risks, to chase the exciting story stocks becomes overwhelming. This is the environment in which investors consistently make their worst decisions. They buy at the top of the market. They take on too much risk. They pay absurd prices for companies based on stories rather than substance. And when the inevitable correction comes, they lose enormous amounts of money. Katsenelson's framework protects you from this by keeping you focused on quality, valuation, and growth, all three together, all the time. When you look at an exciting story stock and run it through the QVG framework, you often find that it fails on valuation, or that its quality is not as strong as the narrative suggests, or that the growth is exciting but priced in already and not sustainable. The framework forces you to think rather than feel, and in investing, thinking almost always beats feeling. Let us now talk about one of the most destructive cognitive biases that affects investors: anchoring bias. Anchoring is the tendency to over-rely on the first piece of information you encounter when making decisions. In investing, the most common form of anchoring is anchoring to the price you paid for a stock. If you bought a stock at $50 and it has fallen to $30, you tend to think of $30 as a loss, even though that has nothing to do with what the stock is worth today. You might hold on, hoping it gets back to $50 so you can break even. But the price you paid has no relevance to the current investment decision. The only question that matters is whether the stock, at $30 today, represents a good investment going forward. Maybe it does. Maybe the stock is now genuinely cheap and the original thesis is intact. In that case, holding or even buying more might be the right decision. But maybe the story has fundamentally changed and the stock is not worth even $30. In that case, you should sell immediately, regardless of the loss you are taking. Anchoring to your purchase price prevents you from making this clear-headed analysis. It keeps you focused on the wrong question, which is, how do I get back to even, instead of the right question, which is, what is the best use of this capital going forward? Active value investors must train themselves to ignore purchase prices when evaluating their current holdings. Evaluate each holding on its own merits today, based on current facts and current analysis, not based on what you paid in the past. Confirmation bias is another extremely powerful and dangerous psychological trap. Once we have formed an opinion about something, we tend to seek out information that confirms that opinion and ignore or discount information that contradicts it. In investing, this means that once you have decided a company is great and bought the stock, you will tend to notice all the positive news about the company and ignore or minimize the negative news. You will read the bullish analyst reports and skip the bearish ones. You will interpret ambiguous information in a way that confirms your positive view. This is how investors end up holding stocks long past the point when the original investment thesis has been invalidated. The active value investor fights confirmation bias by deliberately seeking out the bear case for every investment they own. What is the strongest argument that this company is a bad investment? What would have to be true for the stock to be a terrible decision? By actively looking for the holes in your own thesis, you dramatically reduce the risk of being blindsided by negative developments you could have anticipated. This practice is psychologically uncomfortable because it means deliberately trying to poke holes in decisions you have already made and are emotionally attached to. But it is one of the most valuable habits you can develop as an investor. Let us now talk about how Katsenelson thinks about portfolio construction, because buying and selling individual stocks is only part of the picture. How you put them together into a portfolio has a huge impact on your overall results and on your ability to sleep at night. The first key concept in portfolio construction is diversification, but not the mindless diversification of owning 100 stocks. Katsenelson argues for what he calls focused diversification, owning enough stocks to protect yourself against any single stock blowing up and hurting you severely, but not so many that your best ideas become a trivially small part of your portfolio. If you own 100 stocks, your best idea represents only one unit of your portfolio. Even if it doubles, it barely moves the needle on your overall results. But if you own 20 stocks, and your best idea represents 5 units of your portfolio, a double there meaningfully improves your overall returns. On the other hand, if you own only 5 stocks, and one of them turns out to be a fraud or suffers some catastrophic unforeseen event, it represents 20 units of your portfolio and can permanently impair your wealth. The right number of stocks in a focused value portfolio is typically somewhere between 15 and 30, depending on how many truly compelling opportunities you can find at any given time. The second key concept in portfolio construction is position sizing. Not all stocks deserve an equal allocation. Your highest conviction ideas, the ones where the quality is exceptional, the valuation is most compelling, and the margin of safety is largest, deserve larger positions. Your less certain ideas, where the case is interesting but less clear-cut, deserve smaller positions. This sounds obvious, but many investors treat all their stocks equally, giving the same weight to their strongest conviction and their most uncertain bets. By sizing positions according to conviction and margin of safety, you ensure that your best ideas have the most impact on your results. The third key concept is liquidity. Particularly for individual investors, it is important to focus on stocks that are liquid enough that you can buy and sell meaningful positions without dramatically moving the price. This is generally less of a concern for large individual investors than for institutional investors managing very large sums, but it is still worth considering. The fourth concept in portfolio construction is sector and industry diversification. If all your stocks are in the same sector, you are exposed to sector-specific risks. A regulatory change, a technological disruption, a commodity price shift can all affect multiple companies in the same sector simultaneously. Having representation across different sectors reduces this type of concentrated risk. However, Katsenelson is not a fan of forcing artificial sector diversification. If the best opportunities are in certain sectors and you have done your homework on those sectors, do not artificially dilute by buying mediocre companies in other sectors just for the sake of diversification. Diversification is a risk management tool, not a goal in itself. Now let us go deeper into the concept of range-bound markets and why understanding them is so crucial for investors today and in the coming years. As we established earlier, range-bound markets are periods when the overall market index goes essentially nowhere for years or even decades. They are not continuous crashes, but rather volatile sideways movements, with big up years followed by big down years, never quite breaking to new sustained highs for an extended period. Katsenelson identifies two primary forces that drive markets into range-bound conditions. The first is high P to E ratios at the start of the period. When markets enter a range-bound period from a condition where P to E ratios are very high, those ratios need to contract back to more normal levels. This P to E contraction acts as a headwind that offsets the tailwind of earnings growth. Even if companies grow their earnings nicely over the period, falling P to E ratios mean the stock prices do not advance proportionally. The second force is prolonged economic uncertainty or structural challenges in the economy. When investors face genuine uncertainty about the future economic environment, they are less willing to pay high multiples for future earnings. This uncertainty can come from many sources: excessive government debt, demographic challenges like aging populations, disruptive technological change, geopolitical instability, or simply the aftermath of a period of excessive speculation and misallocation of capital. Range-bound markets have occurred in many countries throughout history, not just the United States. Japan experienced a range-bound market that began in 1989 and by any measure lasted for multiple decades. European markets have had extended periods of going nowhere. Emerging markets, while often exciting over short periods, can go through very long flat periods as well. Understanding that range-bound markets are a normal and recurring feature of financial history, not a rare aberration, is psychologically liberating. It means that when you find yourself in such a market, you are not experiencing something unprecedented. You are experiencing something that has happened before and that has historical precedents for how to navigate it successfully. The key takeaway is that in a range-bound market, passive indexing strategies perform poorly, while active, selective, disciplined investing can perform quite well. This is because in a range-bound market, the average stock delivers average results, which means going nowhere. But individual stocks within the market can still do very well if the underlying businesses grow and if the stocks were bought at reasonable valuations. The active value investor does not buy the market. The active value investor buys specific companies, carefully selected, at specific prices, with a clear thesis and a clear exit plan. In a range-bound market, this approach can generate meaningful positive returns even while the index returns very little. This is the core promise of active value investing, and Katsenelson backs it up not just with theory, but with real historical analysis of how this approach would have performed during past range-bound periods. Let us now explore the concept of intrinsic value more deeply, because this is the North Star of the entire value investing approach. Intrinsic value is the true underlying worth of a business, based on its fundamentals, independent of what the stock market happens to be saying about it on any given day. The stock market can be wildly wrong about the value of individual companies at any given time. Mr. Market, as Benjamin Graham famously described the stock market, is bipolar. Some days, he is wildly optimistic and will offer to buy your shares at prices far above what they are rationally worth. Other days, he is consumed by fear and despair and will offer to sell you shares at prices far below their rational value. The disciplined value investor takes advantage of Mr. Market's mood swings rather than being driven by them. When Mr. Market is offering a wonderful business at a great price, you buy. When Mr. Market has driven a stock you own well above its intrinsic value, you sell to him at that inflated price. At all other times, you ignore his daily fluctuations and focus on the underlying business. This approach requires that you have an independent estimate of intrinsic value that you trust more than the daily market price. And developing that estimate is both an intellectual and an emotional discipline. The intellectual side involves rigorous analysis of the business, its competitive position, its financial statements, its growth prospects, and the quality of its management. The emotional side involves maintaining your conviction in your analysis, even when the market is telling you that you are wrong, which it will do regularly, sometimes for months or years at a time. One of the most important truths in investing is that the market can be wrong about a stock for a very long time before eventually getting it right. A stock that is genuinely undervalued by 20 or 30 units relative to its intrinsic value can stay undervalued for a year, 2 years, even 3 or 4 years before the market recognizes its true worth and re-rates it upward. During that period of waiting, doubt is natural and even healthy. But the active value investor who has done the homework has the conviction to hold and even add to the position while waiting for the market to come around. This requires what Katsenelson calls investment conviction, which is different from stubbornness. Conviction is holding on because the original analysis is intact and the thesis has not been invalidated. Stubbornness is holding on because you refuse to admit you were wrong, even when the evidence has clearly turned against you. Learning to distinguish between the two is one of the most important and difficult skills in investing. Let us now talk about how the active value investor handles economic cycles, because the economy goes through cycles of expansion and contraction that have a significant impact on corporate earnings and on stock prices. The naive approach to economic cycles is to try to time them, to sell everything before a recession starts and buy everything back when the recovery begins. This sounds appealing in theory, but is essentially impossible to execute consistently in practice. No one can consistently and accurately predict the timing of economic cycles. Even professional economists, with access to enormous amounts of data and sophisticated models, are notoriously bad at predicting recessions. Individual investors trying to time the economic cycle will almost always do worse than those who simply stay invested through cycles. The active value investor's approach to economic cycles is more nuanced. Rather than trying to predict the cycle and time the market, the active value investor incorporates the stage of the economic cycle into the fundamental analysis of individual companies. The question is not when the recession will start, but rather, how well is this specific company positioned to handle a recession if one occurs? Companies with recession-resistant revenues, Businesses that provide products and services that people need, regardless of the economic environment, are inherently more defensive. Companies in highly cyclical industries, construction, steel, mining, luxury goods, are far more vulnerable to recessions. The active value investor adjusts the margin of safety required based on the cyclical sensitivity of the business. A highly cyclical company needs to be bought at a much more significant discount to intrinsic value than a stable, predictable business, because the cyclical company's earnings, and therefore its intrinsic value, can fall dramatically during a downturn. Another dimension of economic cycle thinking for the active value investor is how cheap companies get during recessions. Recessions are painful for the economy and for companies, but they are gifts to disciplined value investors who have maintained dry powder, meaning cash available to invest. During recessions, great companies can be bought at extraordinarily cheap prices because panic selling depresses all stocks, regardless of their individual merit. The investor who has been patient and disciplined during the good times, not overpaying for stocks, maintaining some cash reserves, can deploy that cash during the panic and buy wonderful businesses at prices that will generate spectacular returns over the next several years. This is why Katsenelson argues that patience is not just a virtue in investing, it is an active strategy. Sometimes, the best action is to wait, to do nothing, to hold your cash and your high conviction positions, and simply wait for better opportunities. In a world where financial media and social media create enormous pressure to be constantly doing something, constantly trading, constantly reacting to the latest news, the discipline to do nothing when nothing is the right move is enormously valuable. Let us now explore the specific types of situations that the active value investor looks for, the scenarios where undervaluation is most likely to appear. The first, and perhaps most common type of undervaluation opportunity, is the unloved sector. At any given point in time, certain sectors of the economy are out of favor with investors. Perhaps energy stocks have performed poorly for several years, and everyone has given up on them. Perhaps financial stocks are under regulatory pressure, and investors are avoiding them. Perhaps healthcare is facing political uncertainty and has been sold off broadly. In these situations, many stocks within the sector may be undervalued simply because investors are avoiding the whole sector indiscriminately. The active value investor does not avoid a sector just because it is currently out of favor. Instead, they go into the sector, do the homework, identify the highest quality companies within it, and buy the ones that are genuinely cheap based on fundamental analysis. When investor sentiment eventually improves toward the sector, those stocks can re-rate dramatically. The second type of undervaluation opportunity is the company-specific setback. A company that has been doing well can experience a specific negative event, perhaps a product recall, a management scandal, a loss of a major contract, or a disappointing earnings quarter that causes its stock to fall sharply. In these situations, the market often overreacts, pricing in a much worse outcome than is actually likely. The active value investor investigates quickly to determine whether the setback is temporary or permanent. If it is temporary, the overreaction creates a buying opportunity. If it is permanent and fundamentally changes the company's competitive position or earnings power, then the stock may deserve to be cheaper. The third type of opportunity is the spin-off. When a large company spins off one of its divisions into a separate publicly traded company, the newly independent company is often initially overlooked and undervalued. This happens for several reasons. Institutional investors who owned the parent company may be forced to sell the spin-off because it does not fit their investment mandate, perhaps because it is too small or in a different sector. Retail investors may not understand or care about the new company, and Wall Street research coverage may be thin initially. These forced sellers and the general lack of attention create an opportunity for the diligent investor who takes the time to understand the spin-off and recognizes it as a high-quality business at an undervalued price. The fourth type of opportunity is what Katsenelson calls the fallen angel. This is a company that was once a great business but has gone through a period of serious difficulty, perhaps a failed acquisition, a period of poor management, or a temporary disruption to its market. If the underlying business still has strong fundamentals and the difficulties are being addressed, a fallen angel can eventually recover and reward investors who had the courage to buy during the period of distress. However, distinguishing between a fallen angel that will recover and a permanently impaired business that will continue to decline is one of the hardest judgments in investing. Katsenelson's QVG framework is particularly valuable here. By carefully assessing the current quality of the business, the current valuation, and the prospects for growth restoration, the active value investor can make a much more informed judgment about whether the fallen angel is worth buying or avoiding. Let us now go deeper into one of the most practically important aspects of the entire framework, the process of building and maintaining a watch list. The active value investor is not just reactive, waiting for opportunities to fall into their lap. They are proactively building a pipeline of well-researched ideas so that when a stock becomes attractively priced, they can act quickly with conviction. This means continuously researching companies even when their current prices are too high to justify buying. The goal is to know these companies so well that when their stocks fall to attractive levels, you do not need to start from scratch on your research. You already understand the business, you have an estimate of intrinsic value, and you have a price target at which you would be interested in buying. This is what separates the truly professional active value investor from the amateur who is always reacting to the latest news. The professional has done the homework in advance and is ready to act when opportunity presents itself. Building a watch list requires a systematic process. You identify potential investment candidates through various sources, industry publications, screens for stocks with certain financial characteristics, ideas shared by other respected investors, observation of the world around you. You then do the initial research to assess whether the company meets your basic quality criteria. If it does, you build a more detailed financial model, estimate intrinsic value, and determine at what price the stock would offer an acceptable margin of safety. That price becomes your buy target. You add the stock to your watch list and monitor it regularly. When the stock falls to your buy target, you revisit your research to make sure nothing fundamental has changed, and if everything checks out, you initiate a position. This process sounds rigorous, and it is. It requires time, effort, and intellectual discipline. But it is what separates investing from gambling. The gambler buys a stock because someone told them it was going up, or because they have a gut feeling. The active value investor buys a stock because they have done the homework, they know what it is worth, and they are getting a good deal. Let us now discuss something that is particularly important for investors in the context of a range-bound market, the role of dividends in total return. In a bull market, capital appreciation, meaning the rise in stock prices, dominates total return. Dividends are nice, but they are a relatively small part of the total return picture when stocks are rising 10 or 15 units per year. But in a range-bound market, where capital appreciation is limited or non-existent over long periods, dividends become much more important. A stock that yields 4 units per year in dividends and whose price stays flat will still deliver 4 units of return per year, which over a decade compounds to a meaningful sum. And if those dividends are reinvested, the power of compounding can be surprisingly powerful even in a flat market. Katsenelson pays careful attention to dividend yields and dividend growth rates in his analysis of potential investments. A company that pays a consistently growing dividend is demonstrating financial strength because it is generating real cash that it can afford to distribute to shareholders. It is also demonstrating a management culture that prioritizes shareholder returns. And in a range-bound market, it provides a meaningful and visible return to investors even while the stock price treads water. However, not all high dividend yields are good news. Sometimes, a stock has a very high dividend yield, because the price has fallen sharply due to problems with the business, making the dividend, as a fraction of the now lower price, appear very high. These situations are dangerous because if the business continues to deteriorate, the company may be forced to cut the dividend, which typically causes the stock to fall even further. The active value investor distinguishes between sustainably high dividend yields, where the company's earnings more than cover the dividend and the business is healthy, and unsustainably high dividend yields that are warning signs of business distress. Katsenelson also discusses the importance of share buybacks as a way of returning capital to shareholders. When a company buys back its own stock at prices below intrinsic value, it is creating value for remaining shareholders by giving them a larger ownership stake in the business. This is particularly valuable in a range-bound market where the stock price may be significantly below intrinsic value. However, the active value investor is skeptical of buybacks done at elevated prices when the stock is trading at or above fair value. In those situations, the company is destroying shareholder value by paying too much for its own shares. Management that buys back stock at any price simply because they have excess cash and it is the fashionable thing to do is not acting in shareholders' best interests. The ideal management team is opportunistic and patient, buying back stock aggressively when it is cheap and holding cash, or making good acquisitions when the stock is fully valued. Now let us talk about the international dimension of active value investing, because opportunities are not limited to any one country. Global investing expands the universe of potential opportunities enormously. When one country or region is expensive, another may be attractively valued. When certain sectors are cheap only in one country, the active value investor can look globally for additional ideas. However, international investing also comes with additional risks and complexities that must be carefully considered. Currency risk is one of the most significant. When you invest in a foreign company, you are making two investments simultaneously, one in the company's stock and one in the currency of the country where it trades. If the local currency depreciates relative to your home currency, it can significantly reduce or even eliminate the returns from an otherwise good investment. The active value investor must have a view on currency risk and must factor it into their assessment of the margin of safety required for international investments. Political and regulatory risk is another important consideration for international investing. Some countries have weak rule of law, unreliable property rights, or governments that can arbitrarily change the rules for foreign investors. These risks are often not reflected in the financial statements and require careful judgment based on the country's history, its institutional framework, and the current political environment. Accounting standards and transparency also vary enormously across countries. Financial statements from companies in some countries may be less reliable or harder to interpret than those from companies in countries with strong accounting standards and rigorous enforcement. Despite these challenges, the active value investor should not ignore international opportunities. There are many high-quality companies in countries around the world, and some of them periodically become available at prices that offer extraordinary margins of safety. Building the knowledge and the analytical framework to evaluate international investments is a valuable long-term project for any serious investor. Let us now address something that Katsenelson discusses with great wisdom: the appropriate role of macroeconomic analysis in the investment process. There is a spectrum of investment approaches ranging from pure bottom-up stock picking, where the investor ignores macroeconomics entirely and focuses only on individual company analysis, to pure macro investing, where the investor makes bets entirely based on their view of economic trends and ignores individual company fundamentals almost entirely. Katsenelson advocates for an approach that is primarily bottom-up, but informed by macro awareness. He is first and foremost a stock picker who believes that individual company analysis is the most reliable source of investment edge. But he is not willfully ignorant of the macro environment. He uses macro awareness to inform his risk management to adjust the margin of safety he requires in different economic environments, and to avoid the most severe macro mistakes. For example, during the period leading up to the financial crisis of 2008, a macro-aware investor would have noticed the extraordinary levels of leverage in the financial system, the housing bubble, and the dangerous products being sold by major financial institutions. This awareness should have led to avoiding or underweighting financial stocks and being more generally cautious about risk. An investor who was purely bottom-up and ignored these macro signals entirely might have found financial stocks that looked cheap on traditional metrics and bought them, only to see them collapse by 80 or 90 units when the crisis hit. Similarly, a macro-aware investor in the early 2000s would have recognized that technology stocks were priced at completely unjustifiable valuations based on absurdly optimistic assumptions about future growth. Even the best individual company analysis of technology stocks during that period should have been tempered by the recognition that the overall valuation environment was extreme and unsustainable. Katsenelson uses a framework for thinking about the macro environment that focuses primarily on P to E ratios at the market level, interest rates, inflation, and the stage of the economic cycle. He is not trying to predict precisely where these variables will go. He is trying to assess whether the current macro environment represents unusual risk or unusual opportunity for equity investors in general. This macro awareness then informs how aggressive or defensive he is at the portfolio level, while individual stock selection remains driven by fundamental analysis. Let us now talk about the emotional and psychological journey of being an active value investor, because it is not always a comfortable one. The active value investor will frequently own stocks that are going down while the broader market is going up. If you have done the research and you have conviction in your analysis, this can be psychologically difficult. Friends and colleagues who own popular momentum stocks are bragging about their gains. Your stocks are flat or declining. You start to second-guess yourself. Maybe the market is right, and I am wrong. Maybe I am missing something that everyone else can see. This self-doubt is natural and can be healthy if it leads you to re-examine your analysis with fresh eyes. But it can also be destructive if it leads you to abandon a well-reasoned position simply because of temporary market movements. The active value investor needs to develop what we might call analytical confidence, a deep trust in their own process and their own analysis that can withstand the psychological pressure of short-term underperformance. This confidence is not blind arrogance. It is founded on rigorous research, honest self-assessment of where uncertainty exists, and a track record of disciplined process over time. Building this confidence takes years of practice and experience. The investor who is new to the active value approach should not expect instant success. The early years involve making mistakes, learning from them, refining the process, and gradually developing the skill and the psychological resilience that effective investing requires. Katsenelson is honest about the learning curve. He does not pretend that active value investing is easy or that anyone can do it without significant effort and intellectual investment. But he argues convincingly that for those who are willing to put in the work and develop the necessary discipline, the rewards over time are genuinely superior to passive investing, particularly in the range-bound markets that have been, and will likely continue to be, a recurring feature of the investment landscape. Let us now talk about some common mistakes that even experienced investors make, and how the active value approach helps avoid them. The first common mistake is what behavioral economists call the disposition effect. This is the tendency to sell winning investments too early, locking in gains and feeling good about being right, while holding on to losing investments too long, refusing to take a loss and admit a mistake. The disposition effect is exactly backwards from the ideal. In an ideal world, you would sell your losers quickly when the thesis breaks down and hold your winners as long as the fundamental case remains intact. The active value investor's framework of selling based on valuation and thesis changes rather than based on gain or loss, helps combat the disposition effect. The decision to sell is not driven by how much money you have made or lost, but by whether the investment case still holds and whether the valuation is still attractive. The second common mistake is what Katsenelson calls the activity trap. There is a strong psychological pull in investing to feel like you are doing something productive, and trading stocks creates a feeling of activity and control. But excessive trading is one of the most reliable ways to destroy investment returns. Every trade incurs transaction costs, even if they are small. Every trade has potential tax consequences. And perhaps most importantly, excessive trading means you are often making decisions based on short-term noise rather than long-term fundamental analysis. The active and active value investing does not mean trading a lot. It means being actively engaged with your investments in terms of research, monitoring, and thoughtful decision-making. The actual buy and sell transactions should be relatively infrequent events that occur when the analysis clearly calls for them. The third common mistake is herd behavior. There is a powerful human instinct to seek safety in numbers. If everyone else is buying a particular stock, it feels safer to buy it too. If everyone is selling, it feels dangerous not to sell. But herd behavior is precisely what drives stocks to extremes of overvaluation and undervaluation that create opportunities for the contrarian investor. The active value investor must be comfortable being out of step with the crowd much of the time. This does not mean being contrarian for its own sake, or reflexively doing the opposite of whatever the crowd is doing. It means forming your own independent view based on fundamental analysis and acting on that view regardless of what the crowd is doing. Sometimes the crowd is right, and you will find yourself in agreement with consensus. But the value investor's conviction comes from their own analysis, not from what others are doing. The fourth common mistake is recency bias, the tendency to extrapolate recent trends indefinitely into the future. After a long bull market, investors tend to assume that stocks will always go up. After a prolonged period of low interest rates, investors tend to assume that rates will always remain low. After a great run by a particular sector or investment style, investors pile in, assuming the outperformance will continue. But markets are cyclical, and what has worked recently will not always continue to work. The active value investor maintains a long historical perspective, understanding that market environments change and that strategies that are currently out of fashion can come back powerfully when conditions shift. Let us now talk about the concept of normalized earnings, which is central to Katsenelson's approach to valuing cyclical companies. For stable, predictable businesses, current earnings are a reasonable indicator of ongoing earning power. But for cyclical businesses, current earnings can be wildly misleading. At the peak of an economic cycle, a steel company might be earning enormous profits as demand is high and prices are elevated. At the trough of the cycle, the same company might be earning nothing or even losing money. If you use peak earnings to value a cyclical company at the peak of the cycle, you might conclude it is cheap when in fact it is expensive relative to its normalized earning power. Conversely, if you use trough earnings to value a cyclical company at the bottom of the cycle, you might conclude it is expensive when in fact it is very cheap relative to its normalized earning power. The concept of normalized earnings attempts to cut through these distortions by estimating what the company would earn in a normal year, at a typical mid-cycle environment, rather than at an extreme peak or trough. Valuing a cyclical company based on normalized earnings gives a much more stable and meaningful picture of its intrinsic value. Katsenelson walks through specific methods for calculating normalized earnings that are practical and applicable to real-world analysis. The key insight is that the investor must always be thinking about what the business actually earns over a full cycle, not just at the current point in the cycle. Let us now explore some of the specific industries and sectors that Katsenelson uses as examples to illustrate his framework. While the framework is applicable to any industry, certain sectors have characteristics that make them particularly interesting or particularly challenging from a value investing perspective. The financial sector, including banks and insurance companies, is one of the most complex areas for value investors. Financial companies are inherently difficult to value because their balance sheets are full of financial assets whose fair value can be hard to assess, and because they use enormous amounts of leverage that makes them highly sensitive to economic conditions. The financial crisis of 2008 demonstrated brutally how catastrophic the downside can be for leveraged financial institutions when their asset values decline. Katsenelson approaches financial companies with extra caution, requiring a higher margin of safety and paying particularly close attention to balance sheet quality and management conservatism. The best banks and insurance companies are those that maintain conservative lending or underwriting standards, maintain strong capital ratios, and have management cultures that prioritize long-term stability over short-term earnings maximization. The technology sector presents a different set of challenges. Technology businesses can have extraordinary growth and extraordinary competitive moats, but they also face the constant threat of disruption. Today's dominant technology company can be made irrelevant by tomorrow's innovation in a way that is much harder to happen to a consumer staples company or a utility. Katsenelson values technology companies, but requires extra confidence in the durability of the competitive advantage and extra margin of safety in the valuation to compensate for the elevated risk of disruption. Consumer staples companies, those that sell everyday essential products like food, beverages, personal care products, and household goods, are often the classic value investor's hunting ground. These businesses tend to be stable, predictable, and protected by powerful brands that give them pricing power. Their earnings are relatively recession-resistant, and the best ones can be very good long-term compounders of shareholder value. However, even these businesses can be disrupted. The rise of private label products and the changing shopping habits of consumers are putting pressure on traditional branded consumer staples companies in ways that were not anticipated a decade ago. Healthcare is another sector with classic value investing appeal. People need healthcare regardless of economic conditions. The best pharmaceutical companies and medical device companies have significant intellectual property protection in the form of patents that gives them pricing power and durable competitive advantages. However, healthcare also faces significant regulatory risk, reimbursement pressure from insurance companies and government payers, and the uncertain timing of clinical trials for drug development companies. Katsenelson evaluates healthcare investments through the QVG lens, like all others, paying particular attention to the quality and duration of the competitive advantage and the risk profile of the revenue stream. Let us now discuss the role of scenario analysis in the active value investing process. Because the future is inherently uncertain, the wise investor does not just build a single model of the future and calculate a single intrinsic value. Instead, they build multiple scenarios representing different possible futures and assess what the investment is worth under each scenario. A typical scenario analysis might include a base case, representing the most likely outcome, a bull case, representing an optimistic outcome if things go better than expected, and a bear case, representing a pessimistic outcome if things go worse than expected. By calculating intrinsic value under each scenario and thinking carefully about the probability of each scenario, the investor can develop a much richer and more nuanced view of the investment than any single point estimate would provide. More importantly, the bear case scenario analysis helps the investor understand the downside risk. If even in the bear case, the stock appears to be fairly valued or only modestly overvalued, that is a much more comfortable situation than one where the bear case implies catastrophic losses. Katsenelson emphasizes that the bear case should be genuinely pessimistic, not just moderately worse than the base case. It should represent the kind of outcome that could realistically occur if several things go wrong simultaneously. If the bear case looks truly terrible, that is important information that should either reduce the position size or potentially prevent you from investing at all, even if the base case looks attractive. This kind of rigorous downside analysis is what separates sophisticated investors from those who are simply hoping for the best. The active value investor is always asking, what is the worst realistic outcome here, and can I afford it? Let us now talk about the practice of continuous learning that is essential for any long-term successful investor. The business world is constantly changing. New industries emerge. Old industries are disrupted. New financial instruments are created. The macroeconomic environment shifts. Geopolitical configurations evolve. An investor who learned their craft 20 years ago and has not updated their knowledge and frameworks is operating with an increasingly outdated map of the territory. Katsenelson is a voracious learner and models this attitude for his readers. He reads widely, not just financial and business literature, but history, psychology, science, and philosophy. He understands that the best investors are intellectually curious generalists who can draw insights from many different fields and apply them to investment decisions. History in particular is invaluable for investors. The investor who has deeply studied the history of financial markets understands that the patterns of boom and bust, of excessive optimism and excessive pessimism, of periods of stability followed by periods of crisis, have been remarkably consistent throughout human history. This historical perspective prevents the investor from being surprised by events that, while perhaps unprecedented in their specific details, follow patterns that have occurred many times before. Psychology is another crucial field of study for investors. Understanding how human minds work, what biases and heuristics we are all subject to, and how group dynamics and social pressures affect decision-making is enormously useful for both understanding market behavior and managing your own decision-making process. The behavioral finance literature is full of insights that are directly applicable to investment decision-making. Katsenelson draws on this literature extensively, not as an academic exercise, but as a practical tool for becoming a better investor. Business history is perhaps the most directly relevant field of study for the active value investor. By studying how great businesses were built, how competitive dynamics played out in different industries over time, how companies responded to disruption and change, you build a rich mental database that helps you assess the quality and durability of the businesses you are considering investing in today. Let us now bring together everything we have discussed and paint a picture of what the daily practice of active value investing actually looks like for a serious investor. The morning might begin with a review of news and developments related to companies in the portfolio and on the watch list. Not the breathless, minute-by-minute financial news that is mostly noise, but the substantive news about specific companies, industries, and economic trends that might be relevant to investment theses. Part of the day might be spent on deep research into a potential new investment idea, perhaps reading through years of annual reports for a company that has recently come onto the radar, or speaking with industry contacts to better understand the competitive dynamics of a particular sector. Another part might be spent monitoring portfolio holdings, checking whether any developments require updating the investment thesis or adjusting the price target for a position. Regular review of portfolio positions is essential to make sure that the original investment thesis is still intact for each holding. There might also be time spent on what Katsenelson calls the art of doing nothing, the difficult practice of resisting the urge to trade when there is no compelling reason to do so. When existing positions are performing well and the thesis is intact, when no new opportunities are available at attractive prices, the right action is to hold what you have and wait. This is harder than it sounds. The pressure to be active is enormous. But the discipline to do nothing when nothing is called for is one of the hallmarks of genuinely great investors. Portfolio review might happen on a weekly or monthly basis in a more systematic way. The investor reviews each position against its original thesis notes any developments that are relevant, updates valuation estimates if necessary, and assesses whether each position still deserves to be in the portfolio. This systematic review process prevents positions from being ignored and forgotten, which can lead to holding investments that should have been sold long ago because the original thesis was invalidated. The active value investor also maintains a rigorous sell discipline as part of this review process. Every position has a target price at which the stock is considered to be at or near fair value. As stocks approach their target prices, the investor begins preparing to sell, confirming the current analysis, checking whether the business has evolved in any way that would change the fair value estimate, and gradually reducing the position as it moves into fully valued territory. This systematic approach to selling prevents the emotional trap of holding positions too long out of affection for a stock or a company, or selling too early simply because of nervousness about a stock that has risen significantly. Let us now close by returning to the big picture and tying everything together in a way that will stay with you. The core message of Katsenelson's approach is this: intelligent investing is not about predicting the future. It is about understanding where you are, thinking carefully about the range of possible futures, identifying investments that offer good value across a range of scenarios, and exercising the discipline to act on your analysis rather than your emotions. In a world that is noisy, fast-moving, and full of people trying to sell you complicated financial products and the latest investment trends, the simple wisdom of active value investing is genuinely radical. Buy good businesses at reasonable prices. Know what they are worth. Sell when they reach full value. Maintain discipline through market cycles. Think independently. Manage your emotions. Do not overtrade. Maintain a long-term perspective. These principles sound simple, but executing them consistently, over years and decades, through bull markets and bear markets, and range-bound markets, through periods of personal doubt and through periods of widespread financial panic, requires a depth of knowledge, a strength of character, and a clarity of thinking that is genuinely rare. The investors who master these principles and maintain them through difficult times are the ones who build real wealth over the long run. Not through lucky timing or clever speculation, but through the patient, disciplined, analytical application of timeless investment principles to the real world. Katsenelson's work is ultimately an invitation to become a more thoughtful, more disciplined, more independent investor. It is an invitation to see markets not as mysterious and unpredictable forces beyond your understanding, but as collections of businesses being priced by other human beings who are subject to the same emotions and biases that all human beings have. And in that recognition lies the opportunity. When other investors are too fearful, be analytical. When other investors are too greedy, be disciplined. When other investors are following the crowd, think for yourself. When other investors are reacting to short-term noise, focus on long-term value. This is the competitive advantage of the active value investor. Not superior access to information, not faster computers, not a more sophisticated algorithm. Just better thinking, better discipline, and better emotional management than the average market participant. And in a world where so many investors are driven by emotion, short-term thinking, and herd mentality, being genuinely rational and long-term in your approach provides an enduring edge. Let us now go a bit further into what Katsenelson calls the art of valuing growth, because this is an area where many value investors stumble. Traditionally, the value investor and the growth investor were seen as opposites. The value investor was looking for cheap, stable, boring businesses. The growth investor was chasing exciting, fast-growing companies with lofty valuations. But Katsenelson rejects this false dichotomy. The best investment approach combines value discipline with an appreciation for growth. The goal is to find growing companies at value prices, businesses that are increasing their earnings power year after year, but whose current stock prices do not yet fully reflect that growing value. The challenge is in the valuing of growth itself. How much should you be willing to pay for a company's expected future growth? The answer depends on three factors: the rate of growth, the duration of that growth, and the certainty of that growth. A company that will grow at a high rate for a long period with high certainty is worth far more than a company that might grow at the same rate, but only for a few years with low certainty. The P to E ratio that is appropriate for a high-quality, rapidly growing business is legitimately higher than that appropriate for a slow-growing, lower-quality business. The mistake is when investors pay prices that imply unrealistically high growth for unrealistically long periods with unrealistically high certainty. This is what happened with technology stocks during the late 1990s. Boom. Investors were paying prices that could only be justified if those companies grew at extraordinary rates for decades with near certainty. When reality inevitably fell short of those expectations, the stocks collapsed. The active value investor applies the QVG framework to assess the legitimacy of the growth component of any stock's valuation. They ask, is the current P to E justifiable, given realistic and defensible assumptions about the quality of the business, the rate of growth, and the duration and certainty of that growth? When the answer is yes, even at a seemingly high P to E, the stock may be a good investment. When the answer is no, even if the P to E appears modest by historical standards, the stock may be overvalued. This nuanced approach to growth valuation is one of the most sophisticated and valuable aspects of the QVG framework. Let us now explore what Katsenelson has to say about the importance of business model analysis, going beyond just looking at financial statements. Financial statements tell you what has happened in the past. Business model analysis tells you why it happened and whether it is likely to continue. A business model is the system through which a company creates value, delivers that value to customers, and captures a portion of that value as profit. The strongest business models are those where value creation, delivery, and capture are all reinforced by durable competitive advantages. Understanding business models requires deep thinking about the economics of the industry, the competitive dynamics, the customer's perspective, and the long-term trends that are shaping the market. One powerful tool for business model analysis is what strategists call Porter's 5 forces, which examines 5 competitive forces that determine the profitability of an industry: the threat of new entrants, the bargaining power of customers, the bargaining power of suppliers, the threat of substitute products, and the intensity of competitive rivalry among existing players. An industry where all 5 forces are favorable, where entry barriers are high, customers have limited power, suppliers are fragmented and weak, substitutes are unavailable, and existing competitors are rational and not prone to destructive price wars, is an industry that allows participants to earn sustainably high returns on capital. Industries where one or more of these forces is strongly negative are structurally challenging, and companies operating in them will struggle to earn attractive returns no matter how well they are managed. The active value investor evaluates the business model and competitive structure of every company they consider investing in, because this analysis fundamentally determines the quality component of the QVG assessment. A company with an extraordinary business model in a structurally attractive industry deserves a much higher quality rating, and therefore a higher acceptable P to E, than a company with a mediocre business model in a structurally difficult industry, even if both companies have similar current earnings. Let us now address some common questions that investors have about the active value approach. One frequent question is, can individual investors really compete effectively with professional fund managers who have teams of analysts, sophisticated tools, and access to company management? Katsenelson's answer is nuanced. He acknowledges that large professional investors have significant advantages in certain areas. They have more resources for research. They have better access to management. they have sophisticated quantitative tools. But individual investors have some important advantages of their own. The most important is size. A large institutional investor managing billions of dollars cannot invest meaningfully in a small company because even a large position would barely move the needle on their overall returns. Individual investors can invest in small and mid-sized companies that are too small for large institutions to bother with, and these smaller companies are often the most interesting from a value investing perspective because they attract less analyst coverage and are more likely to be mispriced. Individual investors also have greater flexibility. They are not constrained by investment mandates, benchmark concerns, or regulatory requirements that often prevent institutional investors from making contrarian bets. An individual can hold a large cash position when no opportunities are attractive, while many institutional investors are required to remain mostly invested at all times. Individual investors do not face the career risk that haunts professional investors. A professional who underperforms the market for 2 years in a row, even if their long-term track record is excellent, faces real career consequences. This creates a powerful incentive for professional investors to hug the benchmark, to hold positions similar to the index, and not deviate too dramatically, even when their own analysis calls for a more concentrated contrarian bet. Individual investors have no such constraint. They can be fully contrarian when their analysis supports it without worrying about short-term career consequences. These advantages mean that the individual investor, who is willing to put in the work and develop the discipline, can absolutely compete effectively and generate superior long-term returns. It is not easy, and it requires a genuine commitment of time and intellectual energy. But it is absolutely achievable. Another common question is about the role of technical analysis in the active value investor's toolkit. Technical analysis involves studying charts of stock prices and trading volumes to identify patterns that might predict future price movements. Katsenelson's approach is fundamentally based on fundamental analysis, the QVG framework, rather than technical analysis. He does not place significant weight on chart patterns or momentum indicators. However, he is not dogmatically opposed to technical analysis either. He recognizes that market prices contain information and that certain technical observations, such as identifying key support and resistance levels, can be useful in timing the entry and exit of positions at the margin. But technical analysis should never be the primary driver of investment decisions in the active value approach. The primary driver is always fundamental analysis of the business, the earnings, the competitive position, and the valuation. Technical analysis might help you refine the entry point once you have made the fundamental decision to invest, but it should not be driving the fundamental decision itself. Let us now spend some time on what is perhaps the most important advice Katsenelson gives for becoming a better investor over time, and that is the practice of keeping a detailed investment journal. The investment journal is a written record of every investment decision you make, including the reasoning behind it, the key assumptions, the identified risks, the estimated intrinsic value, and the buy and sell targets. The journal also records your actual buy and sell transactions and the results. Most importantly, when you sell a position, you go back and review what you wrote when you bought it. Did your original thesis play out? If not, why not? What assumptions were wrong? What did you miss? What could you have done differently? This kind of systematic post-mortem analysis of your investment decisions is one of the most powerful tools available for improving as an investor over time. Without a journal, mistakes are easily forgotten or rationalized away. With a journal, they are documented and impossible to ignore. The investor who honestly and rigorously reviews their mistakes and extracts lessons from them will improve their process continuously over time. The investor who does not will likely make the same mistakes repeatedly throughout their career. The investment journal is also valuable for tracking the evolution of your investment theses. As you learn more about a company, your view of it naturally evolves. The journal helps you track how and why your view has changed and whether those changes were driven by new information and better analysis, or simply by the movement of the stock price itself. Katsenelson also advocates for writing out your investment theses in full prose, not just in bullet points. The discipline of writing clearly and coherently about why you are making an investment forces you to think more rigorously and identify gaps in your logic that might not be apparent when the ideas are just floating around in your head. If you cannot write a clear, coherent, compelling investment thesis, you probably do not understand the investment well enough to make it. Let us now look at one more crucial topic that is worth exploring in depth: the concept of asset allocation and how active value investing fits into the broader context of a person's overall financial life. The active value investor, who focuses on individual stock picking, is making decisions about how to allocate within the equity portion of a portfolio. But the broader question of how much of total savings and investments should be in equities versus other asset classes, such as bonds, real estate, cash, and alternative investments, is a separate and equally important question. Katsenelson is not a financial planner and does not prescribe a specific asset allocation for all investors. Asset allocation is deeply personal and depends on factors such as age, risk tolerance, time horizon, income, and financial goals. But he does make some observations about how the current market environment should influence asset allocation thinking. In a range-bound equity market where stock valuations are high and expected future returns are likely to be modest, there may be a stronger argument for holding more cash or more alternative assets than in a period when equities are cheap and expected future returns are high. The fundamental principle is that expected future returns should guide asset allocation. When any asset class is expensive and likely to deliver low future returns, you should hold less of it. When an asset class is cheap and likely to deliver high future returns, you should hold more. This sounds obvious, but it runs counter to human psychology, which leads most investors to hold more of what has recently done well, which means they are loading up on expensive assets, and less of what has recently done poorly, which means they are selling cheap assets. The discipline to do the opposite of this natural instinct, to gradually reduce equities when they are expensive and increase them when they are cheap, is one of the most powerful and consistent sources of long-term investment return. Let us talk more deeply about the concept of competitive advantages, because truly understanding them is so central to the entire active value investing framework. A competitive advantage, or economic moat, is any characteristic of a business that allows it to earn returns on capital that exceed its cost of capital sustainably over a long period of time. Without a competitive advantage, a business that earns high returns will quickly attract competitors who want a share of those high returns. Those competitors will invest capital, lower prices, increase marketing spending, or otherwise compete aggressively until the excess returns are competed away. This is the natural economics of competitive markets. Only businesses with genuine, durable competitive advantages can sustain high returns over long periods. The types of competitive advantages we have touched on include strong brands, network effects, high switching costs, proprietary technology or intellectual property, cost advantages from scale or unique resources, and regulatory advantages in the form of licenses, patents, or government protections. But there are more subtle forms of competitive advantage that the thoughtful investor should understand. One is what might be called embedded knowledge or institutional know-how. Some companies have accumulated decades of experience, proprietary data, deep customer relationships, and institutional knowledge that simply cannot be replicated quickly, even with significant investment. A chemical company that has been optimizing a particular production process for 50 years has a knowledge advantage that a new entrant cannot match. A financial services company with decades of actuarial data on a specific risk category has an underwriting advantage that competitors cannot easily replicate. Another subtle competitive advantage is cultural. Some companies have built organizational cultures of innovation, execution, or customer service that are genuinely superior and that translate into better products, happier customers, and stronger financial results. Culture is almost impossible to replicate because it is built over decades through thousands of daily decisions and interactions. A company with a superior culture has a competitive advantage that is both real and almost impossible to copy. The challenge for the investor is that cultural advantages are harder to quantify than brand value or patent strength. They require qualitative assessment, observation of how the company behaves over time, and judgment about whether the culture is truly distinctive or just typical corporate public relations language. Let us now talk about one more important dimension of the active value framework: the importance of having a clear investment philosophy and sticking to it. An investment philosophy is a set of core beliefs about how markets work, what drives investment returns, and what your comparative advantage as an investor is. Without a clear philosophy, you are likely to be buffeted by whatever investment idea or approach is currently popular, changing your strategy every time the market environment changes or every time you read a compelling book about a different approach. Katsenelson has a clearly articulated investment philosophy, active value investing, based on the QVG framework, in the context of a macro awareness about market cycles. He has thought deeply about why this philosophy makes sense, what its theoretical foundation is, and why he believes it will generate superior returns over long periods. This clarity of philosophy allows him to stay disciplined even when the approach is temporarily out of favor. When growth stocks are dramatically outperforming value stocks for several years, as has happened at various points in market history, the active value investor with a clear philosophy knows why they are sticking to their approach rather than chasing the current trend. They know that when valuation discipline becomes fashionable again, as it always eventually does, their approach will once more be rewarded. Developing your own investment philosophy requires time, reflection, and honest assessment of your own strengths and weaknesses as an investor. What do you genuinely know well? What industries or types of companies do you have natural insights into based on your professional experience, personal interests, or geographic location? What are your emotional strengths and weaknesses as an investor? Are you naturally patient or impatient? Are you naturally contrarian or consensus-oriented? Are you comfortable with ambiguity, or do you need certainty before acting? Your investment philosophy should play to your strengths and protect against your weaknesses. The investor who is naturally impatient should build in processes that force patience. The investor who is naturally consensus-oriented should build in checks that encourage independent thinking. The investor who needs certainty before acting should focus on the most predictable, stable businesses where analysis can provide more confidence. Active value investing, as Katsenelson presents it, is not a rigid one-size-fits-all prescription. It is a set of principles and tools that each investor must adapt to their own situation, temperament, and capabilities. Now let us revisit the concept of range-bound markets one more time and explore what they actually look like on the ground for investors living through them. One of the most challenging aspects of a range-bound market is that it is not immediately obvious you are in one. Bull markets and bear markets are easy to identify in retrospect, but range-bound markets look very different while you are in them. The market goes up strongly in some years, making investors feel optimistic, then falls back or goes sideways in others, creating frustration. There is no clear narrative of unstoppable progress. There is no clear narrative of irreversible decline. There is just grinding, volatile, sideways movement that makes investors feel like they should be doing something different without knowing what. In this environment, the investor who has clearly articulated their approach and understands why it is the right one for this environment has an enormous psychological advantage over the investor who is constantly second-guessing their strategy. The range-bound market rewards stock pickers and punishes passive index investors. This is not because active management is always better than passive management in absolute terms. In a strong bull market, where the rising tide lifts all boats, passive investing is very difficult to beat. But in a range-bound market, the average stock, meaning the index, goes nowhere. The active stock picker, who finds the companies that will rise based on their own fundamental merit, rather than being carried along by an overall market advance, can generate meaningful positive returns, while the index returns nothing. The historical evidence for this is compelling. During the 1966 to 1982 range-bound period in the United States, active stock pickers, who focused on valuation and quality, generated strong returns even as the index went nowhere. During the range-bound period that began around 2000, similarly, disciplined active value investors generally outperformed the index significantly. This is the core practical promise of the book. Not just an interesting theoretical framework, but a genuinely different and superior approach for a market environment that has been common throughout history and is likely to recur. Now let us bring everything to a close with some final thoughts on what it takes to be a successful active value investor over the very long term. Long-term success in investing requires more than knowledge and analytical skill, though those are essential. It requires the kind of character that can maintain discipline through boom times and bust times alike. The investor who abandons value discipline during bull markets because it feels too restrictive is not a true value investor. The investor who panic sells during bear markets, despite having done the fundamental analysis, is not a true active investor. The true active value investor maintains their process and their discipline consistently, in good times and bad, in periods of success and in periods of underperformance. This consistency is ultimately what allows the edge of the approach to compound over time into genuinely superior long-term results. Katsenelson's own career as an investor and portfolio manager has demonstrated the power of these principles in practice. He has navigated multiple market environments, including the dot-com bubble, the financial crisis, and various other market cycles, while maintaining his core approach and generating strong long-term results for his clients. His work is not just theory. It is the distillation of real-world investment experience into a framework that others can learn from and apply. The reader who absorbs these ideas deeply, who reflects on them, who applies them systematically, who develops the emotional discipline to act on them in the heat of market turmoil, will be genuinely better equipped to build wealth over the long run than the vast majority of investors. The final message of active value investing is this: the stock market can be your greatest ally or your greatest enemy, depending on how you relate to it. If you allow it to dictate your emotions, you will forever be buying high and selling low, the financial equivalent of running into a burning building instead of out of one. But if you learn to see the market as a mechanism that occasionally misprices businesses, creating opportunities for the patient, disciplined, analytical investor, then the market becomes a tool you can use to build genuine, lasting wealth. This is the promise of active value investing. Not just better returns, but a better relationship with markets, a clearer understanding of what you own and why you own it, and the kind of calm, reasoned confidence that comes from knowing that your investment decisions are grounded in rigorous analysis rather than hope, fear, or the opinions of others. The investor who achieves that understanding has gained something far more valuable than any specific stock tip or market prediction. They have gained a framework for thinking about wealth and investment that will serve them for the rest of their life, in every market environment, through every economic cycle, and through the constant noise and distraction that the modern financial world produces in such overwhelming abundance. Active value investing is not just a method, it is a discipline. It is a way of seeing. And those who embrace it fully will find that it changes not just how they invest, but how they think about value, about risk, about time, and about the nature of wealth itself. This is the legacy of Katsenelson's thinking, and it is a legacy worth carrying forward with you into every investment decision you will ever make from this day forward. The world of investing is full of noise, full of distractions, full of people trying to sell you the next great idea or the next foolproof system. The active value investor knows how to filter that noise. They know how to focus on what matters. They know how to be patient when patience is called for and decisive when decisiveness is required. They know how to manage their emotions without being ruled by them. And they know how to build wealth slowly, surely, and sustainably, the way that great investors have always built it, one carefully chosen, deeply analyzed, reasonably priced investment at a time. The market will continue to fluctuate. There will be new bubbles and new crashes. There will be exciting new technologies and dreary old industries having unexpected revivals. There will be periods when value investing looks brilliant and periods when it looks out of date. Through all of it, the principles that Katsenelson has articulated will remain as relevant and as powerful as they have always been, because they are rooted not in the trends of any particular market moment, but in the enduring principles of how businesses work, how value is created, and how rational human beings can consistently take advantage of the irrational behavior of the crowd. Go forward now with the understanding that you have been given. Apply it with patience, maintain it with discipline, and let the compounding of both your capital and your wisdom do its work over the years and decades ahead. That is the promise of active value investing, and it is a promise worth keeping.